Welcome to Ask a Property Manager, episode number 118. Mortgage rates are up, inflation is up, and refinances are down. What does this mean for home buyers, and what does this mean for home flippers? Stay tuned. Today we're going to be taking a look at the overall real estate market conditions across the country, more or less, in terms of mortgage rates, the interest rate, refinances, inflation, low inventory levels, things of that nature. And the story's a little bit different for home buyers versus home flippers. We're going to go ahead and jump right into the article here. This article was published by NBC News. If my computer will pull it up, there we go. Mortgage refinance demand plunges 60% as rates hit their highest level since 2018. Mortgage rates took another jump higher last week, taking their toll on current borrowers who might have wanted to refinance. Demand from home buyers, however, appears to be hanging in for now. Total mortgage application volume decreased 6.8% last week compared with the previous week, according to the Mortgage Banker Association's seasonally adjusted index. This as the average contract interest rate for 30-year fixed-rate mortgages with conforming loan balances increased to 4.8% from 4.5%. With points decreasing from 5.56, with points decreasing to 0.56 from 0.59, including the origination fee for loans with 20% down payment. So we're talking about conventional loans with a 20% down payment here. The interest rate has gone up from 4.5 to 4.8% overall. And that seems to be what we're talking about, is the steadily climbing interest rates here. Mortgage rates have jumped to their highest level in more than 3 years last week as investors continue to price in the impact of a more restrictive monetary policy from the Federal Reserve. Driving the downturn in overall mortgage demand was a 15% weekly drop in refinance applications. They are now down a whopping 60% from a year ago. The refinance share of mortgage activity decreased to 40.6% of total applications from 44.8% the previous week. Mortgage applications to purchase a home increased 1% a week, but were 10% lower for that same week 1 year ago. Homebuyers today continue to face sky-high prices and record low supply, in addition to rising mortgage rates. Affordability is weakening dramatically, but some real estate agents say the competition is not letting up. I will say I have had more cash buyers this year than I've ever had, and they're borrowing from parents. They're just finding that cash. Because they know it's more competitive with cash offers, said Kelly McMahon, a real estate agent with Compass in Dallas. At an open house held last Sunday, she said buyers were steeling themselves for a bidding war. You have to look at it knowing you're probably going to have to pay $40,000 over asking price, said Lauren Poe, a potential buyer touring the home. It's pretty much the end of the article there. We're going to go ahead and switch back to reporter mode here so that we could talk about this article a little bit more in depth. And there's a couple things that I wanted to talk about. There are several factors in play here, several of which were mentioned by the article. Record low inventory has been plaguing us for years now. Increasing mortgage interest rates is obviously going to be a concern, and a drop in the number of refinances. I want to start by talking about the refinance numbers. In terms of the number of refinances dropping, I think that the reason for this is probably twofold. Early on during COVID, you had a ton of people who were taking advantage of the ability to refinance their property because they wanted to do home projects, they wanted to set themselves up for a work from home opportunity, whatever the case may be. People knew that the market was increasing for real estate values, and they knew that they could pull equity out of their homes to do some of those projects that they hadn't been able to do in the past. A lot of people decided to take advantage of that rather than try to move, and that's where all of the refinances come in. People were pulling the equity back out of their properties rather than try to move in this crazy market, because even if you sell your house, you still have to buy something to replace the house that you just sold so that you have somewhere to live. So a lot of people just opted for that refinance. All of that said, a lot of people were refinancing homes because of COVID. There were a lot of people who had income interruptions at the beginning of the pandemic and put their homes or their mortgages into a forbearance or a deferment status, something along those lines, while they kind of weathered the storm, if you will. And a lot of those people have now come back out of the forbearance or the deferral, and most of those people had to do some sort of a refinance or come up with a big bulk payment when they came out of that forbearance or that deferral. So a lot of people wound up refinancing as a result of COVID due to income changes and things like that in their household. So it's not just a one-fold reason that people are refinancing their properties and things of that nature, but there was a large amount of people who were looking to refinance all at once over the past couple years. So when you're talking about people and refinance statistics and things of that nature, there were a lot of people who just refinanced within these past 2 years, and likely most of the people who were looking to refinance probably have already gone ahead and done it at this point. So seeing a drop in the refinance numbers, especially when you're comparing it to the previous 2 years where we've had such a heavy load of refinances, it's really not something that scares me on a large scale. It's just not. I think that there's probably still plenty of people out there that are looking to do the refi thing, but I think that right now what you're seeing is a little bit of a bump in interest rates combined with the bulk of people who are looking to refinance already taking advantage of the previous interest rates, which is what's leading to that lower volume right now. Now, as far as low inventory goes, that's a problem that's still plaguing pretty much every market in the country as far as I'm aware. I think the one thing that is going to have an impact on the low inventory rate will be the mortgage rate. Traditional home buyers are going to start to fall out of the market. Maybe they'll decide to refinance rather than go out and look for something new or whatever the case may be. I think that as the mortgage rates climb up and if property values continue to climb up with inflation, I think you're going to see more first-time home buyers flushed out of the market. Traditional home buyers will probably start to be a lot more cautious about their offer strategies. And I don't know if you're going to see people that are willing to go $30,000, $40,000, $50,000 over asking price anymore when the money gets more expensive. When the mortgages get more expensive, some of those people are going to opt out. So you're going to lose some of your first-time home buyers and some of your people that are looking to size up in homes. And obviously, if you wind up with fewer buyers in the market, generally speaking, that means that you're going to see more inventory. Maybe not necessarily more inventory, but you're going to see a reduction in the market in terms of the number of multiple offer situations and in terms of the veracity with which people are willing to overbid on things, I guess is a good way of putting it. So you may not have 17 bids and you may not have people willing to pay that 30, 40, 50,000 over asking price. You may wind up with 2, 3, 4 bids and you may be 5, 10 over asking price, or you might be at asking price. Eventually, we're going to get back to a point where the market balances itself out a little bit, and we're not going to see this crazy competition for every single home that comes on the market, regardless of what it's priced at and regardless of what the actual value of the property is. One factor that was not mentioned at all in this article was the inflation rate, and I think that that's something that definitely needs to be discussed because obviously real estate is one of the best hedges for real estate. Obviously real estate is one of the best hedges for inflation that we have here in our country. It's pretty substantial inflation, obviously, over the course of the last couple of years here, and as a result, that has helped to drag our real estate values up right along with it. These things are not a coincidence. Like when you have major inflation, obviously the value of real estate is going to go up right alongside that. Keeping an eye on inflation over the next 12 to 18 months, I think is going to be very, very telling as to just how much damage has been done, long-term damage has been done as we continue to recover from the pandemic and the effects of the pandemic on the economy and on all of us. Depending on whose data you're looking at, inflation seems to be getting pegged somewhere between 4% and 8% for 2021. And honestly, I think it's higher than that. I think it's substantially higher at probably closer to 12 to 15% inflation. And really, I'm basing this on conjecture, if I'm being completely honest. But I know that I'm paying roughly 10 to 12% more this year than I was last year just to maintain my current lifestyle pre-COVID. And not really much has changed in terms of my lifestyle. I haven't purchased a new vehicle personally. I haven't purchased any properties personally. No major capital purchases or anything of that nature that would have a major impact on my debt loads or anything like that. However, the day-to-day expenses of things like food and gas and stuff like that has obviously gone up for all of us. I think that for most of us, that 8%, that 4% number for inflation is a joke. I think 8% is still a joke, and I think that the real number is probably closer to that 12 to 15%. But again, based on conjecture, based on personal opinion, the data that we're seeing is showing between 4 and 8%. As I said, all that I said there, I don't think that the mortgage rates would have a huge impact on some subsets of investors, for instance, such as flippers. And the reason I say that is because flippers kind of operate in a weird space where the interest rate's almost irrelevant to them as long as the deal works. Most flippers are using either hard money or private money to the tune of 12 to 20%. in a lot of instances. And they're still laughing all the way to the bank because the way that they work their deals, the debt load is still supported by the deal. So it's a little bit different situation in a fix and flip type of a situation versus a buy and hold. If you're paying 12 to 20% interest on a buy and hold, that deal's probably not going to work. If it does work, you've got a real gem of a deal. But it's long-term holds, you need those lower interest rates. So the long-term buy and hold investors are going to start having some impact here, especially on commercial notes and things of that nature. But the fix and flip guys, I think, are still going to be okay because most of the people that are doing fix and flip are used to paying high interest rates on that money because they're only holding on to it for a short term. They're only using that capital for a short term. The interest rate doesn't have the same impact. It doesn't have the opportunity to catch up with them, if you will. So if you're a traditional buy and hold investor, this obviously is going to have a much deeper impact than if you are a fix and flip type of person. When you're stuck with those high interest rates for a long period of time, it definitely has a much, much bigger impact on your overall deal and your overall profitability. That pretty much wraps things up for this week's episode. Thank you so much for watching. If you learned something in this episode today, or if you found this style of video interesting, do me a favor and hit that like and subscribe button. And if you have a friend that might be interested, do me a favor and share it with them as well. Questions or comments, drop them below, and we'll talk to you soon.